On May 6, 2010, the US stock market simply stopped showing up. For a few minutes, prices existed without buyers, orders executed without intent, and trillions of dollars depended on systems that quietly stepped aside. What failed that afternoon wasn't valuation, it was trust. This is case number 3, the flash crash. By the late 2000s, global markets had completed one of the largest structural shifts in modern history. The trading floors went quiet, the shouting stopped, the paper disappeared. In their place came something faster and supposedly safer. The market moved into machines. They were production systems, humming inside co-located data centers, physically placed as close as possible to exchange servers in Chicago and New Jersey. Sometimes just meters away, because distance was risk, and milliseconds decided who survived. The promise was simple and seductive because machines don't get tired or hesitate. They provide liquidity continuously, absorbing volatility before a human brain can even perceive it. Liquidity became the promise. Speed became the edge. Automation became trust. Regulators accepted it. Institutions invested billions into it. On paper, it worked. At the center of this ecosystem sat the most critical financial instrument on Earth, the E-mini S&P 500, a scaled-down version of the original S&P futures contract. The original was too large, too slow, too expensive for constant adjustment. This one was built for speed, cheap enough, flexible enough, fast enough to trade risk in real time. And because every major trading system was wired to listen to it, the E-mini became the market's nervous system, traded 24 hours a day, used by hedge funds, banks, and pension funds to adjust exposure instantly. If the E-mini moved, everything else followed. By 2010, most of the volume in the E-mini no longer came from humans, but from algorithms reacting to the market's own signals. Trading had become a closed loop, machines watching machines, responding not to fundamentals, but to each other. Price no longer moved because someone believed something. It moved because an equation detected pressure. This is where the story shifts to Hounslow, West London. Navinder Singh Sarao lived there with his parents. He was a solo trader, operating far from Wall Street, obsessed with how machines behaved when they thought the market was speaking honestly. He didn't study companies. He studied reactions, how algorithms responded to size, repetition, and speed. Over time, he realized something critical. The system no longer asked why an order existed. It only measured how large it was and how fast it appeared. Volume had become credibility. In an automated market, size wasn't just information, it was authority. Large orders implied institutional intent. Persistence implied conviction, and speed implied sophistication. To algorithms designed to provide liquidity, those signals mattered more than truth. Operating from his bedroom, Navinder became one of the largest participants in the E-mini market. To the world's most sophisticated trading firms, his orders looked massive, relentless, and institutional. To the machines, he didn't look like a trader at all. He looked like liquidity itself. In a market where trust was now mathematical, that perception was everything. But no one asked what would happen if that trust was misplaced. By then, the system was accustomed to its own reflection. Algorithms had learned to assume that the signals they saw were honest, because they usually were. The feedback loop appeared stable, self-correcting, safe, until it wasn't. On May 6th, markets were already tense over European debt concerns. Volatility was elevated. Risk systems were on edge. Then, at 2:32 p.m., a familiar pattern emerged in the E-mini. Massive sell orders appearing just above the current price. Thousands of contracts canceled, replaced, repeated instantly. They looked like institutional panic. The orders were real. They hit the order book. They shaped prices. But they were never meant to trade. This was spoofing, creating the illusion of overwhelming supply by placing large orders designed to be seen, not filled. Navinder had used this technique for years, but that afternoon the environment had changed. Under stress, machines behaved differently. Detecting what appeared to be relentless selling pressure, market-making algorithms did exactly what they were programmed to do. They stepped aside. Bids were pulled, spreads widened, liquidity evaporated. And in an automated market, absence is itself a signal. As liquidity vanished, prices began to fall. Not because humans panicked, but because machines retreated in unison. Selling accelerated as algorithms responded to the vacuum they themselves had created. Between 2:41 p.m. and 2:45 p.m., the Dow Jones plunged nearly 1,000 points. Inside that drop, economic logic died. Blue-chip stocks traded for a single cent. Others briefly spiked to absurd prices. Prices recovered within minutes, but the tape did not. The system corrected itself, while the financial damage stayed locked into the ledger. Thousands of trades stood as final, unchangeable entries. It took years to trace the origin. Investigators abandoned the search for a single failed trade and followed the data instead. Every message was replayed at machine speed, order by order, cancellation by cancellation. Sequences were aligned, clocks synchronized, fragments stitched together until the event could be observed as it actually unfolded. The pattern did not originate from a trading floor, a bank, or a hedge fund. It led to a modest house in Hounslow, West London. In 2015, after years of forensic reconstruction, Navinder Singh Sarao was arrested and extradited. The investigation concluded when the signal stopped being statistical and became attributable. The source had been identified. It had operated comfortably inside a system that no longer required belief, only compliance. The infrastructure did not question intent or origin. It responded to presence alone. What emerged was not deception in the traditional sense, but a demonstration of how modern markets resolve uncertainty by withdrawing. The episode showed that liquidity provision had become conditional on readability, and anything that fell outside those expectations was treated as risk. In that environment, influence did not require access, capital, or institutional standing. It required alignment with the system's own reflexes. The result was not a malfunction, but a confirmation of design. Proof that complexity had replaced judgment, and that the market could be steered simply by occupying the space where assumptions live. In the years that followed, the structure remained intact. Adjustments were added at the edges. Responses focused on containment rather than revision. Circuit breakers and trading halts were installed to interrupt future cascades, creating moments of silence when motion threatened to outrun control. These measures slowed outcomes. They did not change the system that produced them. May 6, 2010 became a reference point, a boundary where modern markets briefly revealed how they behave when continuity breaks. Once systems disengage, price stands alone. There is no appeal, no pause, and no mechanism left to dispute the outcome. This was the cash files. Case is now closed.